This is your market close update. US equities extended their rebound, driven by renewed interest in AI and data center stocks. Investors treated recent dips as buying opportunities, while a weaker dollar following the Supreme Court's tariff hearing added support to risk assets. Despite these gains, analysts continue to warn that valuations remain stretched. Momentum is firm, but not cheap. Technically, the overall market score remains in a neutral to hold zone, suggesting balance between optimism and caution. The weekly RSI around the mid-60s indicates steady momentum, while sentiment indicators like the Fear-Greed Index still point to defensive positioning. This reflects a market that looks stable, yet fundamentally overvalued beneath the surface. The key structural risk now lies in leverage. Margin debt remains high relative to circulating cash, implying the system still carries significant exposure. If the S&P 500 breaks below its 20-week moving average, margin call liquidations could accelerate sharply, leading to a potential cascade of forced selling. For that reason, investors are advised to keep at least 30% of their portfolio in cash to manage volatility and preserve flexibility. Bitcoin presents a different story. After a prolonged consolidation, its MAV ratio around 1.85 and weekly RSI in the mid-40s show valuation stability and reduced selling pressure. This indicates that the asset has exited its overvalued zone, with gradual accumulation resuming among long-term holders. A mild uptick in regional premiums suggests confidence is returning, not speculation, but early recovery sentiment. In summary, equities remain expensive while Bitcoin appears technically reset. Investors should stay defensive in stocks, selective in digital assets, and disciplined with cash management. Preserving capital in transition phases often determines long-term success. Always remember, investing involves risks. You are responsible for your own investment decisions.